Parker Gerard here with Evolve Advisor Group, here with our Q2 market outlook. Jumping right in, Q2 was a good year for just about all asset classes. What we're looking at is rates return, year-to-date rates return through the first half of the year. U.S. markets doing well, nice rebound in the second quarter, up 6% on the year. Our international equity markets, though, are really doing well, and we'll talk more about that a little later in the presentation. Fixed income markets all doing well, except our munis are lagging this year. Commodities doing well, and real estate lagging. Really, real estate and munis are only negative returning asset classes here on the year. Individual equity sectors, this has been a volatile year for U.S. equities. Industrials, communications, and information technology, all with a really big rebound here in the second quarter after a tough start to the year. And then other asset classes and other sectors like energy. Energy was our top performing sector in Q1, and here we are back to returns that are nearly flat on the year. So it gave away all their returns here through the first half of the year. Healthcare and consumer discretionary, the only laggards in U.S. equities. And we're even seeing a lot of volatility within some of these sectors. So for instance, the Mag 7, now the Lag 7. The Mag 7 really had a tough start to the year, really led the way down, really pulled markets lower. But after declining nearly 16% in the first quarter, the Mag 7 gained all of that back here in the second quarter, so up 18% in the second quarter alone. So a great rebound here for our Magnificent 7 companies, but they still lag the overall S&P 500 here on the year. One thing that we've been talking about a ton here in the office has been international markets. International markets have really been the biggest bright spot here in client portfolios so far this year. Doubling up, even tripling up U.S. markets. And that's for a couple reasons. One is it's a valuation story. International markets are just trading at more attractive valuations than what we're seeing here within the United States. And so when we talk through client portfolios and what we like in markets, typically we want to be buying stocks that are trading at lower valuations than at more expensive valuations. And so when we go shopping for a portfolio, overseas companies are looking more and more attractive. In addition, we are seeing some pretty big moves this year in the US dollar. US dollar is down 11% through the first half of the year. And a weaker dollar actually acts as a tailwind for us as international investors. So if you think about it, as a US investor, we're taking US dollars and exchanging those for shares of a company denominated in another currency that is strengthening against our currency. And so, like I said, it actually acts as a tailwind for us being US citizens, US residents investing overseas. So it's really that two-part narrative which is driving international market returns this year. The other big story right now is going to be the Federal Reserve, specifically this feud that's been brewing between Washington, specifically the president, and Jerome Powell. Washington is really pushing on the Fed to decrease rates. And what we're seeing from the Fed, most notably last Wednesday, the Fed decided to keep rates steady. So there is a bit of a conflict right now. But what we're seeing is the market really is not expecting all that many cuts for this year. We would say that September, we might have a coin flips chance that we see a cut in September. December is pricing in a higher probability of a cut. But that it's kind of a wait and see on that. We do think that some of this feud as it continues between the president and Jerome Powell, the Fed is really trying to show that they are independent of Washington. And it almost feels like that the more conflict that's there, the more likely we're going to see the Fed keep rates steady. And so, why are we seeing Washington kind of push on the Fed right now? Well, one of those being is just housing. Housing is less affordable than it's been in a long, long time. And mortgage rates have a lot to do with that. We saw mortgage rates increase a lot through 2022, 2023, and then last year as well. As interest rates move higher, housing becomes less affordable. And folks, on average, are delaying their first-time home purchase. So first-time home buyers the age is increasing dramatically. We're seeing on average the first-time home buyer here in the United States is now 38 years old. So there is some pain there within housing at the moment. Again, that's why we're seeing some of this push and pull between Washington and the Fed. But again, the Fed, remember, still has that dual mandate: one, to keep inflation down and keep unemployment as low as possible as well. So more to be seen there. So waited a little longer in the presentation to talk through tariffs this time. Tariff announcements are still causing some market volatility. So as these new announcements are coming out, we're still seeing that they're moving markets up and down. And this is really still a moving target for us. Tariff rates are still high, the highest we've seen since 1941. But again, still a moving target, and likely will be through the end of the year. But I think it's a good time to talk through market volatility. And again, I've sort of made it my mantra to normalize market volatility. And so what we saw earlier this year, we saw a drawdown of about 19%, which is more or less average what we see every year in stock markets. So you turn on the news and everyone, it seems like they're freaking out, but this is more or less normal for markets to see drawdowns like we saw in April of this year. And it's important to remember that drawdowns are typically temporary. Markets have already rebounded. We're already back in the positive on the year from some of that volatility earlier in the year. And I always like to wrap up our presentation with our stocks for the long run chart. As I've mentioned earlier, we have seen volatility this year, but as we know, yes, stocks are the most volatile asset class in the short run, but are the most stable in the long run. And with that, I'll go ahead and wrap up. Thank you again for the time today. If you have any questions, please feel free to reach out to me or anyone else on my team. Thanks.